Index, simply the measure or indicator of something. While we talk of a index in finance, we basically talk the statistical measure of indicating the securities market or the stock market. Hello viewers, I am Amitabala, head of the department, Master of Commerce, Finance and Control, and we are discussing the paper Financial Derivative and Risk Management. In financial derivative and risk management, we are discussing the future market from the couple of classes, and today we are going to discuss the futures that we are taking on the stock index. So without much delay, let's start our today's class. We are going to discuss today the stock index futures. So the stock market index is made up of a basket of stocks that indicate the general movement of stock prices. So while we are trading or while we are doing stock trading, then we are most often heard of the word the stock index. And the stock index, when we are talking, we are hearing of NSE, BSE, Nifty 50, S&P, CNP, like that. We have various stock indexes which are made up of a couple of a certain number of stocks or certain number of indicators of that particular market. That is what the stock index is. So that is what we know, that the stock index is the indicator of a particular stock market, and there are various stock indexes. If you want to know more about that, in our financial market and instrument paper, I have discussed already about what these stock indexes are. Please go through that and be clear that what these stock indexes are. So these stock indexes, if you will observe that they are very much volatile, and there is a high risk of the fluctuation of prices of these stock indexes. So in spite of taking the instrument as stock or taking the underlying asset as stock in the financial derivative, some of the time the traders or some arbitrageurs or some speculators and hedgers, they take a stock index as the underlying asset. So that is what stock index future is. So stocks that make up an index have to satisfy certain conditions like high market capitalization, good liquidity and so on. So the stocks that are considered for the index are having various certain features like market capitalization, liquidity and various other concepts are there, various other conditions are there which are considered while certain stocks are taken into consideration in the index. So these index futures allow traders to cash in on the general movement in stock prices. So as these stock index are the indicators of the stock prices of the particular market or the stock prices of a particular time and situation, thus these index futures allows the traders to cash in on the general movement of stock prices of that particular time or that particular market. These stock futures will enable us to purchase a certain quantity of a specific stock at a predetermined price in the futures. So as like other futures, we are taking or purchasing a certain quantity of a specific stock at a predetermined price for the future date. That is what the stock index future is. So when we buy an index future, we are arranging to trade a specific stock index at a specific price on a specific date. That is what it is, and one makes a profit from an index future if the price of the index is above the price of the index future on the date the contract matures. So one loses if the price of the index is below the price of the futures, and because there is no physical underlying asset to deliver, that is one cannot physically buy an index, so this index futures are settled in cash. So as in other futures or other derivatives we have talked of, we are having the underlying asset. So that depends on the type of the underlying asset that we are taking, either we are settling it on cash or we are settling it on the physical delivery of that asset. In case of the stock index futures, as we cannot have the physical delivery of the stock index, or that is impossible, so here the stock index futures are always settled in cash. So let's understand this with an example. Let's say that Kiran think that the Nasdaq index will move up by 500 points very shortly. So he purchased 100 Nasdaq index futures at US dollar 8,000 each. Now in the meantime, Nasdaq moves up to 8,500 as per the expectation, and Kiran can then exercise the futures at US dollar 8,000 and make a net profit of US dollar 2,50,000. That is what could be the scenario at the favorable point of Kiran. Now, of course, if the index moves in the opposite direction or it goes adversely and hits 7,500, he will have no choice but to buy at the strike price of US dollar 8,000 and make a loss of 2,50,000. So this is what the stock index future is. You can understand that if as per our expectation or as per this Kiran's expectation, the Nasdaq index will move up by 500 points, and as per our expectation it actually moves to 500 points, then we are making a gain. But if it goes down or it goes opposite to the expectation, then also we are making a loss. That is what the index future is. Now, how the trading and settlement of this stock index futures are done? Let's have a look that the stock index futures are similar to other futures contracts. However, the underlying asset is a stock index. So as we have studied about the other futures contracts or the other underlying assets, like that also the stock index futures are working, and the only thing is that here we are taking stock index as the underlying asset. And with any futures contract, there is the agreement to pay a specific price on a set date. So on the expiry date, or for the contract we are taking expiry date and we are arranging to pay a specific price, that is we are determining the price the time we are taking the contract. And index futures are purely cash settled, since it is not possible to physically deliver an index, and the settlements happen daily on a mark to market basis. So we can say that as unlike other futures contracts, these stock index futures are also done. In these types of contracts, we are taking the stock index as the underlying asset, and as like others, we have a predetermined date, we have expiry date, and we have a margin deposit also, and it is not deliverable physically, so it is always cash settled. So when it is cash settled, it is a mark to market basis. That means the profit and loss of this future contract is calculated daily. And this index futures are traded through futures brokers on stock exchanges, and a futures contract can be made through a buy or sell order. So a long position is taken when a buy order is initiated, and a short position is initiated through a sell order. Like other futures contracts, a minimum amount known as the initial margin is also required to take the position, and a maintenance margin is also set, meaning the value must not drop past a certain position, or else a margin call will be initiated, and a trader will then need to deposit funds to meet this margin. So that is what we know that is happening with other futures contracts also. Here also we need to put or we need to deposit an initial margin to enter into the contract, and we have to maintain the margin for any drop of the value, and we need to trade according to the deposition, and we need to fulfill this deposition to maintain the margin amount. At the end of the expiry period, the contract is settled in cash. That means there is no delivery of shares. So, no shares are being delivered, as we are not taking share as the underlying asset, rather we are taking the stock index as the underlying asset. So, here we are settling it down at the expiry period or expiry date on cash. So, if the index is higher than the strike price at the end of the expiry period, the buyer would have made a profit. So, if as per our expectation the index goes higher than the strike price, we are making profit, and if it goes opposite, then we are making a loss. So, if the index is lower, then the seller or future writer incurs a loss. That is what is done with the stock index futures. However, you don't have to wait until the expiry date to sell your futures. You can sell your position at any time period, and the end of the expiry date you feel that these are not moving to your advantage. So, as like other future contracts, as per our expectation, if the stock index goes higher than the strike price, we are making gain, or if it goes down or drop, we are making loss. But there is a provision, or we can also withdraw from the contract at any point if we feel or if we anticipate that we are going to make loss, as the mark to market basis is there. So, according to the current position of the profit that we have already had incurred, but we are not up to the expiration date, and we are anticipating that in the near future or up to the expiration date we are going to make loss, we can also withdraw with the amount of profit that we have made already. So, that is also there with the stock index futures. Now, if you want to trade in suppose rupees 10 lakh worth of these futures and the margin is 5%, you will have to deposit rupees 50,000 with your broker. This is what is the margin is, and this is how we can enter for the futures contract or the futures of the stock index trading. That suppose we are trading for 10 lakh worth and the margin amount is 5%, we have to deposit 50,000 with the broker to enter into this stock index futures contract. So, by depositing this small amount, we will be able to trade larger volumes of 10 lakh rupees. So, for a 10 lakh rupees volumes trading, we can enter into that by mere deposit of 50,000 margin amount, and this will increase the prospect of making a profit. So, on this 10 lakh rupees we are going to make profit, but we are entering into the contract with a mere deposition of 50,000. That is what is the futures contract, how it is done. However, this kind of leverage can lead to considerable losses also if the indices don't move in the way you expect. So, margins are relatively low in futures of stock indices than other futures contracts. So, relative to other futures contract or other underlying assets, margin amount is relatively lower in this futures contract of stock indices. Now, let's have some look on the advantages and disadvantages of these stock index futures. So, if you will see, you can use leverage to take large positions which will increase your chance of profit. That is an advantage with this stock index futures is. But at the same time, it has the disadvantage that this high leverage means that your losses will also be high if these futures don't move in the way you expected. So, if your expectations goes wrong, then you are of a high chance of making losses. That is a disadvantage of these stock index futures. Another advantage of the stock index futures is that investing in these futures is better than investing in individual stocks, because the risks are spread out over several stocks. So when we are taking underlying asset of one stock, or when we are taking a single stock, the risk is definitely higher than when we are spreading it out with the risk of a several number of stocks. That is what the advantage of this is. But it also have the disadvantage that these individual stocks do outperform the index on many occasions. So you will lose out on that possibility of profit also. That could be a disadvantage. Another advantage, we can say that hedging is possible with these futures contracts for portfolio managers. Any losses in the portfolio can be upset by selling their position. So hedging is possible, that is an advantage, but this hedging increases costs for portfolio managers and may hence lower their overall profit, which could be a disadvantage with this stock index futures. You need to pay only a fraction of the transaction as margin to trade this large amount of trading. That is an advantage of this stock indexes, and if you make losses on your position, the broker will demand an additional margin and may sell your position to recover it. So when you are entering into a stock index futures, you need to pay a fraction of amount as the margin, or we are depositing a very small amount of money for margin, but we are trading or leveraging a higher amount or a large amount. That is a advantage with the stock index futures. And if you make losses and on the position that we are taking, the broker will demand an additional margin, that is the maintenance margin, and may sell your position to recover that particular loss, or to maintain that particular loss. That is a disadvantage with this index futures. And if we will talk of another advantage, it allows for making profits from market indices movement. So the market for making profits from this market indices movement is definitely an advantage, whereas there is no guarantee that indices will always move upward. That leads to the losses of this stock indices futures. So these are the advantages and the disadvantages of stock index futures is. So this is what stock index futures is. So when we are talking of stock index futures, we are going to take a financial derivative on the financial instrument, and here the financial instrument is the stock index. As we know that the stock index are the indicator of the stock markets. They are the one which are the statistical measures which are showing us or indicating us that where the stock market is moving towards, or where the stock market is heading towards. So according to the basis of the movement of the stocks, the stock market indices are been determined. In the stock market indices, as we have said, that various stocks are considered or various stocks are taken for the calculation of these stock indices. The stocks that are being considered for the calculation, or the stocks that are the indicator of that particular market, are chosen on various particular grounds or conditions that we have said. It might be the market capitalization or the performance. Many yardsticks are there that are being taken or considered for the stocks that are to be considered in the stock indices. And the number of stocks that are considered in these stock indices are different for different stock indices. Like we say of Sensex, we say of Nifty. There are various number of stock indices that are there, and the consideration of their stocks, their calculations are different. So these stock indices are considered as the underlying asset by the traders, and they are used for hedging, speculating and arbitraging also. As we have already discussed in financial derivatives, there are various participants. So all these participants can or we can say all these participants are taking their position in these stock index futures for the leverage of the risk. So these stock index futures are the underlying asset, and these participants are taking that for leveraging their risk and making profit out of that. So when the expectation goes in favor, they are making profit out of it, and if in case their expectation goes wrong, there is a high chance of loss in these stock index futures also. So as we have seen in this, these stock index futures are having advantages and disadvantages, but it could be a good financial instrument for doing the financial derivative trading. And here we are not considering a single share or a single stock or a single commodity as the underlying asset, but we are spreading out our risk with a number of stocks and shares. Those are the indicator of this stock index. So this is what stock index future is, and this is what the concept and the working or the settlement and the advantages and disadvantages of this stock index futures. In our further classes, we are going to learn more on these financial derivatives. I hope this class is interesting and you understand that what these stock index futures are. So for today, this is all. Thank you.